Where do I start? How long will it take to reach my goals? Can I build a 6 or 7-figure portfolio with just $50 or $150 a week? What's the best strategy to get there? If you're asking yourself these questions, this video is for you. In this video, I'm busting the myths about the huge upfront investment needed. I will show you and Josh how anyone can build a wealth through smart dividend strategies. No excuses, no shortcuts, just results. I will share a tailored portfolio for this strategy, and in the end, I'll show you whether you can reach $1 million valuation with only $50 or $150 weekly investments. Setting the stage, the problem and solution. Most people think about dividend investing. They imagine needing huge sums of money to make it worthwhile, and they're not wrong, on the surface. Sure, the idea of living off dividends sounds great, but when you hear stories of people earning thousands in passive income, you realize they're sitting on million-dollar portfolios. For most of us, that feels way out of reach, right? But for that, I have the creative visualization that underscores how strategic approaches simplify dividend investing and make financial goals achievable. The bar chart shows the transition from problems to solutions in dividend investing across 3 key factors: initial capital, patience, and consistency. Red represents the difficulty level, while green highlights how the proposed solution mitigates these challenges. For instance, the significant initial capital challenge is reduced through smaller, consistent contributions like $50 or $150 weekly. Similarly, the patience required becomes manageable as the solution emphasizes long-term growth. Consistency, once seen as difficult, turns into a strength as the solution capitalizes on reinvestment and compounding. It can feel overwhelming to start from scratch. If you're like Josh and most beginners, the biggest hurdle is believing that small, consistent investments can make a difference. After all, what can $50 a week really do when dividend yields are only a few percentage points? Add to that the temptation to chase high-yield stocks or the impatience that comes with waiting for results, and it's no wonder people get discouraged. The key here is compounding. By investing a manageable amount every week and reinvesting your dividends, you're leveraging the power of compounding. It's like a snowball rolling downhill. It starts small but grows larger and faster over time. And with the right stock picks, you're not just looking at capital appreciation, you will watch your dividend income grow year after year. Let's simplify the concept of compounding with a one-time investment example. Let's say Josh invests $100 today and it earns an average annual return of 8%, a mix of dividend income and capital appreciation. With compounding, your investment grows not only based on the initial $100, but also on the returns it generates each year. At the end of the first year, your $100 grows by 8%, adding $8, for a total of $108. In the second year, your returns are calculated on the $108 rather than just the original $100. This means you earn $8.64 in year 2, 8% of $108, bringing your total to $116.64. Without compounding, the growth would remain constant at $8 per year, resulting in $116 after 2 years. However, with compounding, you've earned an extra 64 cents. Not much in 2 years, but over decades, this effect becomes exponential. For example, after 30 years, that same $100 would grow to $1,006, thanks solely to compounding at 8%. This simple example highlights how reinvested returns accelerate growth, making compounding the most powerful tool in building long-term wealth. In the end, I'll show you whether you can reach $1 million valuation with only $50 or a $150 weekly investment. Selection criteria for the dividend portfolio. Now that we've talked about the power of starting small, let's dive into the criteria I use to select dividend stocks. Because let's be honest, not all dividend stocks are created equal. Choosing the right ones is what makes this strategy work. First up is dividend yield. This tells you how much you'll earn in dividends relative to the stock price. A higher yield might seem tempting, but here's the catch. Super high yields can sometimes signal a company is in trouble. Instead, I aim for stocks with sustainable yields, typically in the 2 to 5% range, because they strike the perfect balance between current income and growth potential. Next is the dividend growth rate. It's not just about how much a company pays now, it's about how much they'll pay in the future. Companies like Hormel or PepsiCo, for example, have consistently increased their dividends over the years. This means your income grows without you lifting a finger. I love looking at the 10-year compound annual growth rate, or CAGR, for dividends to spot winners. A good range for me is between 5 to 15%. Then there's the payout ratio. This measures how much of a company's earnings go toward paying dividends. A healthy payout ratio, usually under 60%, means the company has room to grow those dividends while reinvesting in its business. Also, diversify across sectors and focus on companies with strong fundamentals for steady, reliable, long-term returns. With these criteria in mind, you'll be set up for a portfolio that doesn't just look good on paper, it delivers real, sustainable results. Next up, let's break down the weekly portfolios of $50 and $150 and see how these criteria come to life. And in the end, I'll show you whether you can reach a $1 million valuation with only $50 or $150 weekly investments. The portfolio. I am aiming to create a portfolio that balances stability, growth, and consistent income. The focus is on carefully selected stocks that not only pay reliable dividends, but also compound significantly over time, turning small steps into massive financial progress. This portfolio is built with 5 stocks, each serving a strategic purpose in creating a blend of security and growth. At the heart of this portfolio is Vanguard's S&P 500 ETF, or VOO, a rock-solid investment that gives you exposure to the biggest and best companies in the market. With a dividend yield of 1.24% and a steady growth rate of 7.19%, VOO acts as the anchor of your portfolio. On top of that, its annual share price appreciation of around 10% means you're not just earning dividends, you're also seeing your investment grow over time. Next, I have Hormel Foods, or HRL, a household name known for its dependable products and even more dependable dividends. With a yield of 3.67% and a fantastic 10.94% dividend growth rate, Hormel has proven itself as a reliable income generator even during tough economic times. Then there's Target, or TGT, a retail giant that brings both growth and income to the table. Its dividend yield of 3.43%, paired with an 8.86% dividend growth rate, makes it an excellent choice for balancing risk and reward. For a growth boost, I have included CubeSmart, or Cube, a high-yielding real estate investment trust, REIT, specializing in self-storage solutions. This one's exciting because of its 4.98% dividend yield and a solid 14.65% dividend growth rate. With rising demand for self-storage, CubeSmart is positioned for strong returns and brings valuable diversity to your portfolio. Finally, there's PepsiCo, or PEP, the dividend aristocrat that needs no introduction. With a yield of 3.58% and a dividend growth rate of 7.73%, PepsiCo is a powerhouse of both income and growth. Each stock in this portfolio plays a unique and essential role. Vanguard's S&P 500 ETF anchors the portfolio with stability and steady growth, while Hormel Foods offers reliable dividends and resilience during tough times. Target balances growth and income, benefiting from strong consumer spending trends. For accelerated growth, CubeSmart provides high dividend yields and exposure to the booming self-storage sector. Finally, PepsiCo, a global powerhouse, delivers consistent payouts and long-term appreciation. Together, these investments create a blend of security, growth, and income designed to compound wealth over time. This portfolio delivers a 3.38% dividend yield for steady income, a strong 9.87% dividend growth rate to compound returns, and a 5.2% average share price appreciation for long-term growth. The beauty of this portfolio lies in how it grows over time. Here's what happens if you invest $50 weekly into this portfolio. $50 future projections. In the first year, your $50 weekly contributions total $2,600, setting the stage for compounding growth. After 10 years, the portfolio expands to $40,834, generating dividends that are automatically reinvested to accelerate its momentum. By year 20, the portfolio reaches $170,923, providing an annual dividend income of $5,774. Fast forward to 30 years, and you're looking at a portfolio valued at $786,809, paying an annual dividend income of $84,550, or $7,046 per month. Even without an initial lump sum investment, this portfolio shows how small, disciplined actions can lead to significant wealth accumulation. Next, let's see what happens when we scale this strategy up to $150 weekly contributions. The $150 weekly portfolio. While the $50 weekly portfolio is an excellent starting point for building wealth over time, Increasing your contributions to $150 a week takes your investment journey to an entirely new level. With more money to invest, you can not only accelerate the compounding process, but also design a portfolio that leans more heavily into growth while still maintaining stability and consistent income. Here's what happens if you invest $150 per week into this portfolio. By the end of the first year, you will have contributed $7,800, which immediately gives this portfolio more room to grow. After 10 years, the portfolio expands to $122,503, 3 times the value of the $50 portfolio at this stage. By year 20, it grows to $512,769, and by year 30, it hits an incredible $2,360,428. The dividend income follows suit, with annual payouts reaching $253,650 by year 30, over $21,000 per month in passive income. What makes this portfolio different from the $50 portfolio isn't the scale of contributions, but also the allocation strategy. With $150 a week, you can allocate more to growth-driven stocks like CubeSmart and Target, which have higher dividend growth rates and long-term capital appreciation potential. The combined graph for $50 and $150 weekly contribution portfolios showcases the transformative power of consistent investing and compounding over time. Both portfolios begin modestly, but as the years progress, their growth accelerates, highlighting how time and reinvestment work together to create substantial wealth. The $50 portfolio, with steady weekly contributions, grows to $786,809 in 30 years, while the $150 portfolio achieves an impressive $2,360,428 in the same time frame. The difference between the two portfolios becomes especially noticeable after the 10-year mark. While they track closely in the early years, the $150 portfolio diverges significantly as reinvested dividends and higher contributions amplify its growth. This widening gap underscores the exponential nature of compounding. The more you invest, the faster your portfolio grows, especially over longer periods. By year 30, the $150 portfolio generated over $21,000 in monthly dividends compared to $7,049 from the $50 portfolio. Whether you begin with $50 or scale to $150, the key is consistency, reinvestment, and allowing time to maximize the rewards of your investment strategy. Both paths lead to financial freedom, but scaling can help you get there faster. Don't want to invest weekly? Click the video on screen to find out what happens if you make a one-time investment of $10,000.